Hey guys, welcome back to another video. Today we will go over the fundamental steps to understanding and using support and resistance levels to improve your trading strategy. Because support and resistance levels are key areas in trading the financial market, we have created this video to clear the junks out of its concept. So here is a quick breakdown of what we will be covering in this video. To help us in creating content like this, please click the like button, subscribe, and turn on the notification bell to get notified whenever we upload a new video. Now, let's get right into the video. Technically speaking, a support level is a price level at which the price had difficulties to break below, while a resistance level is a price level at which the price had difficulties to break above. As a result, traders expect that those levels could again form an obstacle for the price in the future. To properly employ support and resistance, you must also be aware that there are two main forms of support and resistance, such as minor and major levels. Minor levels are expected to be broken, whereas strong levels are expected to hold and force the price to move in the other direction. For example, here the price is trending lower. It makes a low, then bounces up, and then starts to drop again. This low can be marked as a minor support area because the price did break through and moved down below the level. But since the trend is down, the price is likely to fall through the minor support level without much problem due to much selling pressure. Similarly, here the price is in an uptrend. As it moved up making higher highs, it retraced back at this point and finally went up making a new high. This high can be marked as a minor resistance level because the price did break through and moved higher above this last resistance level. Areas of minor support or resistance provide analytical insight and potential trading opportunities. Going from the examples, if the price does drop below this minor support level, then we know the downtrend is still intact. But if the price stalls and bounces at or near the minor low, then a range could be developing. If the price stalls and bounces above this major low, then we have a higher low, then we mark it as an indication of a possible trend change. Now that you have known the basics of support and resistance, let's look at the false breakout and rejection of support and resistance levels. False breakouts are a breakout of support and resistance levels that fail to continue beyond such level. A false break of a level can be thought of as a deception by the market because it looks like the price will break out and continue, but then it quickly reverses, deceiving all those who took the trade of the breakout. False breakout patterns are one of the most important trading patterns to learn because a false break is often a very strong sign that the price might be changing direction. For example, on this chart, we can see a key resistance level that held the price on two tests. Then on the third test, the price created a large false breakout that signaled a potential up move, but later started a downtrend. As we can see in this chart, not only did the false breakout signal a down move, but it kicked off an entire downtrend, going the other way. Here we had this support level, which was tested multiple times by price action, and then got this breakout on the last attempt, which signaled downward continuation, but later reversed and started an upward movement. Breakout is often the case that amateurs will enter the market with what looks like a clear breakthrough of a level, and then the professionals will push the market back the other way, leaving you out of the market with losses. A clear understanding of false breakout and the price action that formed following it gives you an edge over other traders, but we will make a detailed video on price action and how to trade with it. Now, moving on to the next one. When the price reaches a support or resistance level, the price can either bounce off the line or break through it. When the price breaks through, the role of the two lines reverses. If it was a line of support, it will turn to resistance, and if it was resistance, it turns to support. For example, here on the chart, as the price was trading down, it broke through this support level and continued trading down. As the price came back to this level, it found resistance and reversed downwards. Similarly here, the price is trading in an uptrend, and as you can see, it broke the resistance level and made a new high. As the price came back to this level, it found support and reversed upwards. This denotes that the resistance level has become support level for this new price range. A pro tip: support and resistance levels are technical analysis tools predicting where an asset's price will tend to stop and reverse. These levels are identified by repeated contacts of the support and resistance area, frequently accompanied by high volume. Moving on to the next one. We've got many ways to draw support and resistance, but for this video, we will go through these 3 steps. Horizontal support and resistance levels are the most basic type of these levels. They're simply identified by a horizontal line in areas. First, here on the chart, you need to identify a past price level where the price had difficulties to break below. Then mark it with a horizontal line that extends into the future. Once the price approaches this horizontal line again, there is a high chance that the price will retrace from that line. Now the problem with using horizontal lines is that this line doesn't get to touch all the points that could act as support and resistance, so we try using areas. For example, on this chart, we identified these points where price found resistance and went downward. Instead of using horizontal lines, we use area. These will help us have a broad look at how the price behaved at the resistance level. Now moving on. Trend lines are often used to identify support and resistance in uptrends and downtrends, since the financial market likes to trend. Here on the chart, each time the price approaches the trend line, there is a high chance that the price will bounce off the trend line or break through it. Just like with horizontal support and resistance levels, the trend line should have at least 3 price touches before it is considered important. Trend lines can either be upward or downward sloping. Now moving on. Dynamic support and resistance levels always change their role with new price movement or direction. To draw dynamic support and resistance levels, traders usually use moving averages, which are automatically drawn by your trading platform. The 200, 100, and 50 period exponential moving average are very popular dynamic support and resistance levels. You can equally adjust the moving average according to your trading strategy, but if you watched our previous video, you will know that we use the 50 period exponential moving average. Here on the chart, you can see that when the price was trading downwards, the moving average was acting as the resistance level using these 3 price points, but when it started trading upwards, the moving average also acted as the support level, also using these price points. So this is practically the application of switching or changing of the support and resistance levels. It is important to note here that the more time has passed since establishing a support or resistance level, the more likely it's no longer relevant, as new support and resistance levels are usually more important than older ones because they represent a fresh price level where the market had difficulties to break above or below. It is a common wisdom among traders that the more times the price has bounced off instead of broken through a support or resistance level, the stronger that level is believed to be. It is also wise to note that if many traders are in the market, after multiple touches, that level may as well break. To get around this problem, look for solid rejection of the support and resistance levels after many touches. It is also quite good to look at the candlestick formation towards a support and resistance level, as it would give you more information on the behavior of traders in the market. Now moving on. The Fibonacci retracement tool is an extremely popular tool used to identify price levels where a price correction might end, so that the long-term trend can continue. I have a detailed video on the Fibonacci retracement tool and how to use it. I will leave a link in the description below, so go and check it out. Now, to use the retracement tool, here on the chart, as the price is in an uptrend, you first identify the most recent major swing low on the chart. This is the major swing low, and then you identify the major swing high, which is this point. Then you select the retracement tool from the toolbar and plot from the low of the swing low to the high of the swing high. The tool must connect the low and the high of the move. These 3 lines that result after are the Fibonacci retracement levels. As you can see, the price found support exactly at the 50% level. Now, going the other way in a downtrend, the procedure will be reversed. Here we identify the most recent swing high on this chart, which is this point. Again, we identify the most recent swing low on the chart, which is this point. Then we grab the retracement tool and draw, connecting the high of the swing high and the low of the swing low. Since the price is in a downtrend, we expect the Fibonacci levels to serve as the resistance level. As you can see, the market found resistance at the 61.8% level, which is the golden ratio, and immediately reversed downward. Now moving on to the next one. Every trader tends to ask the question, what time frame is best for trading support and resistance levels? Well, in practical trading, it is a wise decision to perform a multi-time frame analysis on the weekly, daily, and lower time frames, depending on the type of trader you are. This helps to identify long-term and short-term support and resistance levels. To be more specific, support and resistance levels on the higher time frames tend to hold more weight than on the lower time frames. Let's jump right into the price chart and take some examples. Here is a clear moving uptrend because the price is making higher highs and higher lows, and we want to trade in the direction of the market. You identified the key level of support here because of these reversal point. Again, you have your trend line placed, which crosses through the support level you identified. You then have your moving average that also meets the trend line perfectly at this point. This way, increasing the quality of the trade setup. Finally, we grab the Fib tool and click starting from the swing low here and drag it up to the recent swing high. As you can see, the 50% Fib retracement level also lines up perfectly with the trend line, support and resistance, and as well, the moving average. In this way, creating an area of confluence. When price reached this level, we had multiple long-wick candles forming and failing to break through, which shows a reaction to the area of confluence and then confirms the trade setup. And you will start looking for a long trade entry opportunity. Because at this area of confluence, all the different forms of traders are looking to take action. First, you had support and resistance traders looking to take long trade. You had moving average traders looking to take long trade, trend line traders looking to take long trade, candlestick and price action traders looking to take long trade, trend traders looking to take long trade, confluence traders looking to take long trade, and then finally, you had Fibonacci traders looking to take long trade. At this point, if you decide and enter a long trade, I think you will have high chances of the trade going in your favor, which means that this is a high-quality long trade entry setup. To help us in creating content like this, please click the like button, subscribe, and turn on the notification bell to get notified whenever we upload a new video. Thanks for watching. See you in the next video.